David, just want to come to you on the kind of real estate rally that we saw yesterday. Be it a DLF, Unitech, HTIL, all these stocks surged, and not just the price action, but volumes as well picked up quite heavily. What is it that you like out of the realty basket, if at all?
Well, I think one thing was obvious even before also, and today also. The rate reduction possibility would definitely bring up the mood back into the rate sensitive sectors, and that certainly includes real estate. Fortunately, in case of real estate companies, as I would say, I think most of the companies have been quoting at below the book values, the amount of asset that they would carry vis-a-vis the kind of market cap the companies are enjoying. From that point of view, I think a re-rating is definitely required, possible, and the fall in the rate of interest would once again, I think, assume the higher amount of demand coming in, largely to begin with the housing sector space and followed up with the commercial space. Most of the companies are having the stock to offer, and those who are having the portfolio of stock to offer would be the first one to get benefited. The theory says that in this year, the FY 13-14 financial year, many of these companies, including the likes of DLF and Unitech, would certainly have higher amount of numbers to talk about, and that's where I think the market has taken up the position. I think that about a month or two back, I think the market started getting the wind out of it, and that's why they started taking the position. I believe that the real estate space could possibly offer an upside, given the kind of momentum that the market is assuming currently, and given the kind of beta effect possibility that one could talk about with the rise in the market going forward. So I would say that I think selective investment in real estate would definitely make sense.
Then, I can think of at least 20 listed real estate stocks. Let's nail it down to one or two ideas.
If you ask me, Nikunj, I think my real choice stays with, I think, a safer bet, like I think Mahindra Lifespace. I like that company more because I think Mahindra Lifespace and Godrej Properties, I like these companies more because of the kind of a business model that they have adopted. They are not leveraged. Their management style is, I think, very comfortable for investors like us, I think, who look at long term. And at the same time, I think these companies have larger amount of properties to offer going forward in this year as well as in the next year. So to a greater extent, I think given the kind of margin of safety requirement in our portfolios, we like to buy into these two companies, Mahindra Lifespace and the Godrej Properties.
What about DLF, HDIL, India Bull Real Estates? Your opening remark was that the reason why real estate stocks are outperforming is because interest rates could come down. So if I look at the total debt profile of Mahindra Life Sciences or Godrej Properties, they hardly have any debt. So why do you like them?
Yes, Nikunj, I think as I said that I prefer margin of safety, and I like the style of management. They don't take the debt in the books, and that's where we like these two companies. I'm not saying that DLF, Unitech kind of companies will not perform well in this year. I think the possibility of they performing well in the compared to other two would be on a higher side, even though if I have to put across my investment idea to a certain extent on one side, they would perform faster compared to my investment ideas. But the fact that I think we carry the long-term investment pattern in our portfolio, so we prefer to stay with companies where the management is more consistent and they don't take up a higher amount of risk, they don't take up larger amount of debt. The DLF and the Unitech, if they have learned lessons from past, probably I think they may remain more disciplined, and that's where I think one could probably take some chance. If not, I think for long-term investment portfolio to begin with, maybe I think for short-term positioning point of view, these companies could possibly assume some amount of beta effect and give better performance compared to others into the market space.
Even Axis Bank as well is slated to come out with its earnings. A, if you would have penciled in any estimates from this one, and B, generally what is your whole sense of how the private banking lot is going to pan out this quarter?
Well, I think more or less the private banking space is likely to operate on a predicted lines. Take case of Axis Bank, we believe that around 15-16% kind of a net interest income growth and around 15-16% kind of a non-fee based, non-interest based income growth should be possible in this particular quarter for Axis Bank. Given the kind of infrastructure exposure, they may probably show little muted growth compared to other private sector banks. compared to the likes of HDFC and others. IndusInd, of course, I think is in Yes Bank, I think they've definitely followed a different model. But to a greater extent, I think you find that this particular bank would show around 18 to 20% kind of a bottom line performance, 16% kind of a top line performance growth in this particular quarter. I would think that the models are pretty much predictable across, I think, in the private sector space, be it Axis Bank, be it ICICI Bank, be it Indus or Yes Bank or HDFC Bank. I think you find that the models are quite predictable. In some cases, you are going to see the growth rate of around 25% plus. In some of the cases like ICICI, they would stay in the range of 20 to 25%. And I think Axis Bank particularly, I think would stay probably, I think, below 20% kind of a growth rate. So easily you can probably make out. I would think that I think banking space would require some amount of some amount of correction if one wants to buy further, because in last 6 months to 12 months, I think this space has given good performance. So it may remain in some amount of corrective phase, and during that corrective phase, you may have to add into your portfolio. We certainly like some of the names which I have talked about in the private sector space, particularly ICICI Bank, which you would like to add more into the portfolio in the corrective period.
Devin, what is it that you like out of the PSU banking lot? And after the recapitalization news, we saw a fair amount of run-up in these names. Do you think there's still further headroom for a catch-up to play with the private banking lot?
Well, I think catch-up to play with private banking would be a little long game. I think, to my mind, I think within the PSU banking space, if you ask me, I think our first choice remains with first three banks, that is the State Bank of India, the Bank of Baroda, the BOB and the PNB. These three banks remains under the favorable choice, as we call it, because of the valuation comfort that we get in all three of them, B, the kind of size that they have created, and C, most importantly, we believe that in the coming budget, the government or the finance minister would probably come out with some kind of a roadmap for consolidation of the banks. And should that happen, then some of these large banks like SBI, PNB and BOB would definitely have an advantage over some of the smaller banks. So to a greater extent, I think we believe our first entry into these three banks. And of course, I think within the mid space you have corporation banks also, I think, which one could probably look at a little bit more favorably. So we believe in taking some selective calls into the private sector banks, particularly more public sector banks, particularly more because of the kind of valuation advantage also it offers, and given the prospects which I just spelled out.
Okay, a Morgan Stanley report has also just hit my mailbox on TCS, and Morgan Stanley also is clearly now making a case that 2013 could be a better year for large cap IT stocks. And in the year 2013, the calendar year 2013, large cap IT stocks, they really could register a big revenue uptick. Now, TCS and Infosys numbers are out. HCL is due on 17th and Wipro numbers are out on 18th. Devin, do you think HCL Tech and Wipro could also surprise us on the upside after TCS and Infosys?
Not so much about HCL Tech. HCL Tech is, I think, more on a predicted lines, given its run-on-the-mill business model, which is continuing to perform better performance even in the earlier period also. So HCL Tech would be more or less on a predicted lines as I see it. Of course, I think the direction point of view, I believe that I think even HCL Tech would join in the bandwagon and say that about the positives for the new intake of the flows of the business. The more important thing and interesting thing would be to watch out for would be Wipro. Wipro, under its efforts to restructure the IT business and probably focusing more onto the consulting space, I would think that the Wipro could possibly surprise going forward on an upside. And given positive environment, I think Wipro holds that capability to surprise on an upside. So one will have to really look for whether it happens in this quarter, it will happen over subsequent quarters. One will have to really look for. But Wipro remains, I think, a little bit more on a favorable look at this point of time. Also, given the kind of the fact that most of the times in the past, the Wipro has not been added into the portfolios, there is some amount of space available into the respective portfolios to add into the Wipro. So it could possibly, from market price point of view, also surprise market participants going forward in next 12 months.